Mortgage-backed securities. Mortgage-backed securities, MBSs, provide another example of how financial markets convey savings to finance investment in real assets. In this case, the real assets are homes, which homeowners finance in part with mortgage loans. In the old days, the 1960s, for example, most mortgage loans were made by local banks, savings banks, and savings and loan institutions, S&LS, and which accepted deposits and savings accounts and made mortgage and other local loans. We will use an S&L as the example. The flow of savings would be as described by the figure in panel A, at the bottom of this box. The typical mortgage was long-term, up to 30 years maturity, with a fixed interest rate. The S&LS liabilities. Chiefly savings accounts had much shorter maturities, perhaps a year or two on average. The S&LS were therefore borrowing short, lending long, a dangerous investment strategy. When interest rates rose in the 1970s and 1980s, the S&LS interest costs on savings accounts rose, too, but their interest income was locked up in long-term, fixed-rate mortgages. Losses mounted. The S&L crisis of the 1980s followed. Times. The invention of the MBS allowed S&LS to eliminate the risks of borrowing short and lending long. You can still get a mortgage from your local S&L, but now the S&L does not have to keep it. The S&L originates the mortgage but will probably resell it to an MBS issuer, for example, Fannie Mae Federal National Mortgage Association or FNMA, and or Bank of America. The issuer combines your mortgage with hundreds or thousands of others and issues an MBS backed by the combined portfolio. The MBS is sold to investors such as life insurance companies that want to hold long-term, fixed-rate obligations. Cash flows from the mortgage portfolio are passed through to investors. Suppose a life insurance company purchases an MBS. The flow of savings would now match the figure in panel B. The invention of MBSs also made mortgages liquid. They are actively traded among banks, insurance companies, mutual funds, pension funds, and endowments. The MBS market grew explosively through 2005. With the growth came more and more complexity. Issuers were not content with the simple pass-through MBS described earlier. They issued complicated packages of securities called tranches. The most senior tranches were given first call on all cash flows from the mortgage portfolio and were viewed as almost risk-free. Bond rating agencies gave their highest, AAA ratings to the senior tranches, even for MBSs based on subprime mortgages for homeowners with weak credit. Many investors in AAA tranches lost a lot of money in the crisis of 2007-2009. We discuss bond ratings in Chapter 6. The MBS market survived. It is still by far the largest source of mortgage financing. By 2018, the aggregate value of mortgage-related securities outstanding exceeded $9 trillion. MBSs are part of a broader market for asset-backed securities, which includes securities that work like MBSs but are based on portfolios of other types of assets, including car loans, bank loans to businesses, and financing for commercial real estate.